Managing money, income taxes. We've seen taxes before in the form of sales tax. Let's take a look at a quick reminder. An exercise machine with an original price of $860 is on sale at 14% off. If the sales tax in your state is 6.5%, what is the cost of the exercise machine? Remember, when we set up a percentage problem, we use proportions. We see the discounted price of the new cost of the exercise machine is $739.60. Now to take care of the tax. The tax on the exercise machine was $48.07, bringing our total cost of the exercise machine to be $787.67. It is true that there are many types of taxes, including sales tax, gasoline tax, and property tax, but for most Americans, the largest tax burden comes from federal taxes on wages and other income. The complete tax code is many thousands of pages long, and it changes almost every year as Congress passes new tax laws. Nevertheless, the basic idea behind income taxes is relatively straightforward. The purpose of this section is to be able to understand income taxes well enough to make intelligent decisions about both personal finances and political tax questions. Income tax is a percentage of your income collected by the government to fund its services and programs. The federal government collects income tax, and most, but not all states do too. Alaska, Florida, Nevada, South Dakota, Texas, Washington, and Wyoming have no state income tax. Tax revenue pays for our national defense, fire and police protection, road construction, schools, libraries, and parks, to name a few. Although the United States Congress determines federal tax law, the Internal Revenue Service, or IRS, is the governing body that enforces the laws and collects taxes. Federal income taxes are a percentage of your taxable income, which is based on your earnings in the calendar year. Calculating your federal income taxes begins with your gross income, or total income, for the year. This includes, but is not limited to, income from wages, tips, interest or dividends from investments, unemployment compensation, profits from a business, rental income, and even game show winnings. Adjusted gross income is figured by taking your gross income and subtracting certain allowable amounts called adjustments. These untaxed portions of gross income include contributions to certain retirement accounts, tax-deferred savings accounts, interest paid on student loans, and alimony payments. The tax code tries to encourage long-term savings by allowing you to defer income taxes on contributions made to specific types of savings plan called tax-deferred savings plans. Money that you deposit into these accounts is not taxed now. Instead, it will be taxed in the future when you withdraw the money after you retire. You are entitled to certain exemptions and deductions, or subtractions, from your adjusted gross income before calculating your federal income taxes. An exemption is a fixed amount on your return for each person supported by your income. You are entitled to this fixed amount for yourself and the same for any dependent. A standard deduction is a lump sum amount you can subtract from your adjusted gross income. Most young people claim the standard deduction because their financial situations are relatively simple. An itemized deduction are deductions you list separately if you have incurred a large number of deductible expenses. Deductions vary from person to person. The most common deductions include interest on a home mortgage, state income taxes, property taxes, contributions to charity, and certain medical expenses. When you file your taxes, you have two options for deductions. You can claim the standard deduction, or you can itemize your deductions. Note, you must claim either the standard or itemized deduction. Let's take a look at an example. Suppose you have the following deductible expenditures: $2,500 for interest on a home mortgage and $900 for contributions to a charity. Your filing status entitles you to a standard deduction of $6,350. Should you itemize or claim the standard deduction? If you were to itemize your deductions, you would be able to claim $3,400. Instead, you should claim the standard deduction of $6,350. By claiming the standard deduction, you are entitled to reduce your taxable income by more, thus paying less in taxes. You always want to claim the larger of the two deductions. A tax table or tax rate computation allows you to determine how much tax you owe on your taxable income. However, you do not actually pay this amount if you're entitled to any tax credits. A tax credit is the amount of money taxpayers can subtract from taxes owed. The value of a tax credit depends on the nature of the credit. Certain types are granted to individuals or businesses in locations, classifications, or industries. Another common one is the child tax credit that many parents can claim. Unlike deductions and exemptions, which reduce the amount of taxable income, a tax credit reduces the actual amount of tax owed. Tax credits are more favorable than tax deductions or exemptions because tax credits reduce liability dollar for dollar. Most people pay all or part of their tax bill during the year, either through withholdings by an employer or by paying estimated taxes. If you have paid more than you owe, then you should receive a tax refund. Let's recap. We start with our gross income. We subtract any adjustments to that income. These are contributions to those tax-deferred savings plans, which winds us up with the adjusted gross income. From the adjusted gross income, we subtract any deductions and exemptions, which gives us our taxable income. Once you find the taxable income, you use the marginal tax rate table to determine your tax computation. Once you compute the tax calculation, subtract any tax credits to find the total income taxes owed for the year. Let's take a look at an example. Karen earned wages of $38,200, received $750 in interest from a savings account, and contributed $1,200 to a tax-deferred retirement plan. She was entitled to a personal exemption of $4,050 and to deductions totaling $6,350. Find Karen's gross income, her adjusted gross income, and her taxable income. Since Karen earned wages of $38,200 and earned $750 in interest from a savings account, this brings her gross income to $38,950. Karen contributed $1,200 to a tax-deferred retirement account, which qualifies and is an adjustment to her gross income. Thus, her adjusted gross income would be found by subtracting that amount. In order to find her taxable income, we subtract the exemptions and deductions, bringing her taxable income to $27,350. This is the amount the federal government is going to use to find her federal income tax burden. The standard deduction and tax calculations depend on your filing status. The following is a basic outline, and you should always consult your tax preparer on how best to file your individual tax returns. There are four main filing status. Single, which is unmarried, divorced, or legally separated. Married filing jointly, you and your spouse file a single tax return. Married filing separately, married and you and your spouse file two separate tax returns. And head of household, you're unmarried and paying more than half the cost of supporting a dependent child or parent. The marginal tax table allows you to determine how much tax you owe on your taxable income. The United States has a progressive income tax, meaning that people with higher taxable incomes pay at a higher tax rate. The system works by assigning different marginal tax rates to different income ranges, or margins. Your tax bracket is the income margin or income range your taxable income falls within. For example, a single individual with a taxable income of $25,000 falls within the 15% tax bracket. Let's take a look at an example. Deidre is single with no dependents. Her adjusted gross income is $90,000. Calculate her income taxes for 2017. Since Deidre is single, she has no dependents and makes no mention of itemizing her deductions. We will assume she claims only one exemption for herself and claims the standard deduction for a person filing as single. Remember, her adjusted gross income was $90,000. Deidre falls in the 25% tax bracket since her taxable income is $79,600. In order to calculate her income taxes owed, we must compute the taxes owed at each of the previous brackets. We begin by finding how much Deidre owes in the 10% tax bracket. The first $9,325 of Deidre's taxable income is going to be taxed at 10%. Thus far, Deidre owes $932.50 in federal income taxes. Next, we must figure out how much Deidre owes in the 15% tax bracket. Here's where we need to be careful. The first $9,325 has already been taxed at 10%. We need to figure out how much of Deidre's taxable income is going to be taxed at 15%. $37,950 minus $9,325 leaves us with $28,625 of Deidre's taxable income to be taxed at 15%. Adding that to the previous taxed amount, Deidre owes $5,226.25 in federal income taxes thus far. Finally, we must figure out how much Deidre owes in the 25% tax bracket. $41,650 of Deidre's taxable income will be taxed at 25%. Deidre owes a total of $15,638.75 in federal income taxes.